So let's go to Connell McShane and Lizzie Wicked McDonald. Love both of you. Liz, on this, first off, and the budget accord, the president indicated that he's on board with it. It gets a couple of things out of the way. It's not perfect, but, you know, both parties can move on to other things.
Well, I don't know how you move on to other things when the reason why the market sold off was when that 10-year kept going up inexorably to 2.85. When it should be a safe haven play, when the market cracks up, you'd think the yield would be going down. No, it kept going up. I mean, and S&P is out with a new report. There's something like an increasing number of U.S. corporations that are, quote, highly indebted. It's up 5 percentage points. I mean, the dollar
and it doesn't take much, to your point,
It doesn't take much for the repricing, vicious default scenarios coming through the bond market when the Fed starts raising rates and the soapbox derby crack-up of government bonds worldwide competing with each other for yield. I mean, we're talking about $20 trillion estimated in government printing during the last financial crisis. So what's the fallout of that? I think that definitely the markets are trying to wrestle with this scenario of government and corporate debt.
They don't quite have a handle on it yet.
I think we'll probably have a bunch of stories that we'll have to do between now and whenever about bond market vigilantes again. I mean, maybe we'll assign them to EMAC. I brought a couple things I was just reading about a little bit before coming down, that for the first time in 4 years, U.S., Japan, Eurozone, and the U.K. will together issue more debt than their central banks will buy. So it's kind of a real shift in the environment that we're in. And then you go back, I mean, there's a historical precedent, obviously, for everything. You don't have to go back that far, but just on the numbers to early in the Clinton administration, late 1993, you had a 10-year at 5.2%. Then over the course of like a year and a half to 2 years, it goes from 5.2 to 8%. And that did force the hand of the government at that time.
Yeah, that's right.
Don't
force
them to cut it down. There are a lot of people who
right.
don't remember rates that high, which was more in the historic norm than what we've seen over the last, let's say, 10 years. And the argument behind this whole back and forth on the sell-off is what's an acceptable backup in rates? Because the easy money days are gone. You keep hearing that talked about. But we don't know what would be considered hardship.
Yeah, that's right. So the talk was, 2.6 when it starts breaking through that on the 10-year year. That was a, oh, my God, panic moment. Now it's 3%. I mean, to Connell's point, it's a great one. When it started going and Greenspan started raising rates, the bond vigilantes, Robert Rubin, got upset about it, worried about it. You had Clinton and Gore downsizing the size of U.S. government when the yield starts shooting up.
Well, they would never have done that
is well taken.
Without that.
Well, what is the break point? Is it 3%? Is it 3.5%? When does the markets go, golly gee, this is bad, right?
And that's the only thing that's going to make the move. I mean, I think Gasparino mentioned this a little bit earlier when you're on, but like, you know, wishing that these guys that you're going to have anybody, it doesn't matter who they are, but whoever's in power back then, or it's Mitch McConnell and Chuck Schumer right now, that are going to come out and all of a sudden have this, some lightning's going to strike them and be like, oh, we'll have fiscal discipline. The only thing that's going to force their hand are markets.
Right, because remember, James Carville back under Clinton said the crowd that really has the power, it's not the Pope, it's not the president, it's the bond market.
The bond market, right.
He said the bond market back then.
Yeah, remember when they struck that deal when Clinton first tried to get a handle on spending? I guess we're all Eisenhower Republicans right now. Yeah. And, of course, in retrospect, it was a good thing he was at the time. Yeah. But having said that, I mean, do you guys think we're out of the woods on this one? I know we've got these fast market conditions where not only bond prices tick and move very quickly, but stocks do as well. We've had, I think, today about a 450-point spread in the Dow. I mean, it's getting to be almost commonplace, but do you think we're going to calm down here soon?
I don't know. The Federal Reserve is out with their CPI report next week, and it's been stuck at one...
Write that down. When will that be?
Geek moment. You're a geek of the moment of the day. So it's stuck at 1.8% core CPI for the last 8 months or so. So I don't know. I mean, I got to say, I think you guys are absolutely right. I mean, I think people are taking their eye off the ball. Oh, it's wage gains. That's inflation. No, it's the bond prices. Wage gains don't create inflation. Demand does. Demand sets prices,
Is the problem because these are still low rates. I mean, they're not as low as they were, but they're still really, really low.
Historically, yeah.
Is the fear, Connell, that they're going to back up more than we thought? In other words, this idea that, to the president's tweet earlier, good news is bad news, and I don't understand that. But in this case, the good news is bad news because the better it gets, the more rates back up.
And I think a lot of it depends on the pace, on how fast they go. So if it goes from, you know, where we were 2.7, now 2.8, and then we're all of a sudden jumping up and it's 3.2, 3.3, and it happens quickly, then very quickly you could be retesting lows in the stock market, right? I mean, that was a really quick... really, really fast move.
Yeah.
I mean, you talked about some of the reasons why you think it may have happened. It was a really, really fast move, essentially over 2 sessions. So to say that it's all over with, I mean, obviously I have no idea, but it may be a little bit premature. That doesn't the market want to say, well, let's retest some of these lows, as it often does from a technical perspective, and then, you know, we see whether or not they hold. We just don't know.
Real quickly, Lizzie, I get concerned about these program trading abilities that we have now that are very unemotional, that are figured on algorithms, and there are a ton of these different algorithms, but all these exotic devices out there to shield you from market forces, which you can't do.
Which you can't do that, and it was really unbelievable that last year the S&P didn't go down by more than 3% at any time. We've never seen that in the history of the country. And so I'm always worried that the regulators have not caught up to the robots, that they could be painting the tape or doing something we don't know yet.
We don't know, but it's open the pod bay door, Hal time. That's what it is. 2001 Odyssey reference there.